Coming up in today's video, we got HELOC's policy changes under the radar. Today we're talking about what could be a game changer for people applying for a new mortgage when you have a HELOC. Coming up next, stay tuned. Pow! Michael Jacob Zach, welcome to the channel. And if you're new to the channel, make sure you subscribe. Hit that notification button for more market updates with Canadian real estate, specifically Toronto real estate. Now, getting in today's, we're talking about HELOCs and a policy change that happened on Tuesday, and it was kind of done under the radar, which is kind of suspicious, but more or less, we're going to be talking about how this is going to affect real estate moving forward and what it all means. All right, for those who don't know, a HELOC is a home equity line of credit, which is essentially, it's a loan that you can use. If you don't use it, you're not paying for it. It comes with lower interest rate because essentially it's backed by your property. Now, this has been widely used or been, it's a growing thing over the last couple of years because banks have been using this to get more business essentially. Now, and they've been promoting it, hey, it's not going to affect you and all that. Like only if, if you use it, you got to make your payments and yada, 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 you pay your interest, but essentially it's not going to affect you. So they've been advertising this for the last, and it's been growing really big. So essentially what's happened though is there's been a policy change in TD, which is the biggest HELOC player in Canada, made this policy change along with, RBC is making this policy change. Now, essentially, this policy change is a big deal because up until now, HELOCs, and because real estate's grown so rapidly, HELOCs have been more, pushed out because essentially if you have, a $400,000 house and, it's almost paid off, $100,000 left, there's room to play there that they can give you this loan that, if you use it, they can make some more money off you. Now, where people have been using this is mainly for the, down payments for more property, to get out of, to put the 20% down, to, get out of high insurance premiums, or, to give money to their kids for them to buy property. So HELOCs are definitely a big player in when you look at real estate as a whole. And that's why when you look at our debt, it's staggering, growing and growing and growing because these HELOCs have been promoted and people have been using them, which is good. But with this policy change, might affect, it's a game changer the way I look at it. Now, this new policy change, who's this going to affect? Essentially, what this change means is they're going to stress test you when applying for a new mortgage. And how they're going to do that is whatever your HELOC max value is, they're going to assume that you're going to max that out. So that payment is going to come into effect for your income that you can afford that second, mortgage or whatever you're buying or whatever you're doing. So essentially, they're going to stress test anyone with an existing mortgage and a HELOC that want another property and if they're able to afford that. Now, when you look at the numbers for the average borrower that has a line of, of a HELOC of $200,000, what this means is when you go to apply for that new mortgage, that they're going to have to prove that you can afford an additional payment of $1,200. Now, what this is going to do is either one, bring your buying power down, or essentially, make it, max you out where you can't even buy that second property. Because $1,200 for, many people is going to definitely hurt them on their buying power. Now, why they're doing this? They're doing this for the sake of, they're being proactive because with rising interest rates, HELOCs are affected with, all loans are affected, but they're just being proactive so that at some point, and we all know interest rates are going up with the economy being so well, they're just being proactive. So this is something they should have been doing for forever, but they know their numbers of what people are doing with these and essentially did not want to hurt the market, but now they're doing it. So it's something that everyone, who has a mortgage now is going to keep that mortgage with that HELOC, and whatever they're going to do with it, it's going to be affected. Now, obviously, this is going to affect people with HELOC. So if you do have a HELOC, there's a few things you can be doing in terms of when you're applying for that new mortgage. One, you can close your HELOC, which, like I said, to me is an option, but that's probably your last option you want to be doing. Your first option is going to be just use a different lender that doesn't apply this policy change. Now, right now you have TD, RBC. These guys are doing it. It's only a matter of time till everybody does it. So keep that in mind. If you are looking to do something, you want to move kind of fast on this, because you might have a few months, might have 6 months, but who knows, right? These changes come pretty fast. Now, you can reduce your HELOC to make sure that you pass the stress test. That's obviously a fair option. You can get your HELOC and turn that into just an amortized mortgage. To me, it kind of defeats the purpose, because usually when you have a HELOC, you have it for flexibility. You could pay it off fast right away. You don't have to pay any fees and all that. You just pay your interest that you've been paying on it, and essentially, you have it for that reason. Now, banks have been advertising this stuff for years, HELOCs, because, like I said, they're trying to drum up sales, but at the same time, they use it to secure your business, because when you go in there and they pitch you this idea, obviously they're going to make some money off you, but at the same time, when it comes down for renewal of your mortgage, they tend, instead of when you go somewhere else, when you have an outstanding, HELOC somewhere, you're going to pay, fees and all that with that new lender. So they use it to secure more business. So that's why they've been pushing it really heavily for the last couple of years. And at the same time, with real estate growing and people not borrowing, they just, hey, use this line of credits, essentially this money available to you, and just, pay it back as needed, as long as you make your minimum payments and all that. Similar like, any line of credit, or just, like a credit card type thing, with much lower interest, because it's secured back by your real estate. Guys, I want to know your opinion on this. Do you think this is going to affect the market? Obviously, I think the second, cottage and rental market and investment stuff like that's going to be affected. So I'd like to hear what you think. Like, comment, share, and we'll catch you on the next one, guys. Take care.